As anticipated, the FOMC formally announced its taper program after their November meeting. Beginning later this month, purchases will be reduced by $15 billion per month. The size of the Federal Reserve's balance sheet will therefore stabilise in June 2022, with only the proceeds from maturing securities invested from then on. Showing confidence in the recovery to date and the economy's prospects, the taper timeline to mid-2022 has been set on an unconditional basis. The key questions for the market from here are therefore when to expect the first rate hike and how high the peak of the cycle will be. It is clear from the FOMC's November communications that the current supply chain and energy-related price pressures are not a valid justification for interest rate increases. Moreover, global recovery from the pandemic is expected to see a reduction in inflation as supply constraints ease, not an increase in price pressures. The decision to commence rate hikes after the taper concludes will therefore depend on the strength of the labour market, the momentum it gives to wages, and, with a lag, consumer inflation. While the US has seen unusual strength in wages growth recently, as for consumer inflation, this momentum stems from supply proving insufficient for demand due to the protracted nature of the recovery from the pandemic. Though the FOMC will continue to monitor these developments, it is expected that wages growth will not sustainably grow at a strong pace until full employment is achieved and maintained. In November's post-meeting Q&A, Chair Powell affirmed it is possible maximum employment can be regained by the end of 2022 if current trends continue, franking their September forecast of a 3.8% unemployment rate at December 2022. We concur with this forecast for the labour market and consequently believe December 22 is most likely to see the first rate hike by the FOMC. This week's post-meeting communications and available data also justify believing that the rate hike cycle that follows the first move in December 2022 will be modest versus history. Currently, we anticipate conditions will require 2 additional rate hikes in the first half of 2023 to 0.875%, and come 2024, a further 3 hikes to 1.625% by September of that year. This forecast endpoint for the tightening cycle is more or less in line with the end 2024 projection of the FOMC committee, but well below their longer run rate of 2.5%. It is also below the committee's medium-term expectation for inflation of 2%. This implies that at the end of 2024, US monetary policy will be accommodative on both a nominal and a real basis, allowing the US economy to continue growing at or above trend. It is therefore appropriate to expect that not only will their 10-year yield hold materially above the federal funds rate as the rate hike cycle commences, but also as it matures, with the risk of a need to act further on rates remaining priced in. To give a sense of our view on the scale and persistence of this uncertainty, our forecast for the 10-year peaks at 2.3% in mid-2023, after which the yield is expected to slowly move lower to 2.1% by the end of 2024 and 2% come end 2025. Throughout the period, wage gains will remain the chief risk to this benign view on policy. If supply proves insufficient for demand, then wages growth will be bid up to a level that not only offsets current inflation pressures, but also allows for additional discretionary consumption. The FOMC will only act more aggressively with rates if demand sustainably drives aggregate inflation higher, because at that point, price pressures and expectations become self-reinforcing and in need of an offset. We'll see you next time.